Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hello, and welcome back to the Get Real Podcast. This is Heather Marchant. Ron is at a awesome mastermind this week, learning new ways that we can help our clients. So super excited. I always get a little bit overwhelmed when he goes to these though, because he comes back with big ideas. And if you've been around here a little while, you know that Ron has big ideas and I execute his big ideas. That's kind of how the magic happens over here. So I also hold my breath like, oh man, he's at a mastermind. This could make my life a little busy.
big ideas roll downhill, right?
That's right. That's right. So I have with me today, Brendan Kolesar, and he is with Cherry Creek Mortgage. Brendan, do I say your last name right?
Kolesar. Yeah.
Kolesar. So I have to add an extra syllable in there. Kolesar. Yep. Got it. Yep. When you chat and know each other, I feel like I know you pretty well, and I don't know how to say your last name. Then that's the reality of our digital age.
Absolutely. Well, you're not the only person. I mean, there's folks I've known much longer that still butcher it, and my first name too. So you're doing
really. Yeah. Wow, I'm winning. Thank you. I appreciate that. So we just finished up our 3-day series of sessions for the masterclass. You sat in on most of those, I think, Brendan, when your work day. But we talked a lot about rates, interest rates, and the market and what's happening right now, what we think is going to happen, and that's been really, really impactful. If you want to tune into those and watch the recordings are posted in our Facebook page. If you'd like to be added there, please email us at invest@rcinvest.com, and we will set you up and get you the right link so that you can get in on that. We announced a couple of exciting things. We're going to talk about one of them today. Also talked about our investor portal quite a bit and gave a tour of our investor portal on day 3. And we have a lot of excitement buzzing over that. So we'll be covering that on a future, probably our next podcast, once we've let the dust settle with a bunch of new users on there. So excited about that. So Brendan, thank you for kind of just being willing to just chat it up with me a little bit about rates. I know you do that every day. So
Absolutely.
Like no your normal life. So yep. Other people would have to prepare. I don't think you had to do anything probably. You're just like, yep, hop on a chat.
It's day to day. It's part of the process now.
Yeah. So rates have just been so volatile. And we were just talking about that the last couple of days. We've had them come down a little bit, which is.
Yeah, we've seen the 10-year dip back below 4, and we've had a pretty good improvement in mortgage-backed securities. So we're seeing, we're getting some breadcrumbs. It's always interesting. And, I probably alluded to it last time I was on here with you, but it's so much tougher for them to giveth, but they love to taketh away is what I always say. So getting rates back is always a challenge, but it's something that I'm always leaning really hard into our secondary team on, just to find out how much are we improving on a daily basis? A 3-day rally compared to, what we've had now, a 10 months of going the wrong direction. It's really inspiring for someone like me sitting at this desk and seeing some positive movement, but all these banks that have been beat up for the last 10 months, it'll take a little time for us to start seeing improvements like that are substantial, but the signs are nice.
We take the wins, man.
Yeah,
we take
absolutely.
them.
Absolutely.
Go ahead.
I was just going to say, I think yesterday I sent you guys some updated rates, and, they had improved by 1/8, and I was super excited about that. So the wins, we take them. You're right.
I know. And it's really funny because I get just as excited over here and oh my gosh, that's going to be what, $20 of cash flow, or depending on the property, right? So it's still a win, and it's a lever that we pull. We talked about levers in the master class that we did as well, about, little things you can do. And you're a master at that, Brendan. I feel like we underutilize your skill at being able to direct clients in the best ways to buy down the rate, to improve the performance, increase the cash flow. It really helps that you're an investor and that you get it, right? That it's really about making the properties cash flow as best we can.
Yep.
I know our team doesn't underutilize you. We definitely, we definitely ask you lots of questions daily about interest rates and specific properties. And in this volatile rate environment, we're just having to communicate all the time.
It's kind of nice
rates,
though.
so.
I mean, it's good to have that connectivity, right? And have everybody on the same page with the goal on what a consumer needs, what we need, what you guys need to be able to perform on a property. So I don't mind it at all.
Yeah. So talk to me a little bit about the creativity that you use with different loan products, because where rates are changing all the time, what are some different options investors have now?
Yeah, I mean the big two were obviously the 30-year fixed for the well qualified client. That's a Fannie Mae type product where you're capped at 10%. Depending on qualifications, another product has been the DSCR, the debt service coverage ratio loan, which is it's all geared towards the performance of the property. And your guys' property is always qualified just because of the way you structure your deals and make sure they're performing. It's interesting, when someone asks me about that product and they're coming up with a property on their own or a California property, for instance, I mean, it just doesn't work. You really have to dig in and pencil out, what the numbers are going to be to make that a functional product. And then more excitingly, and most recently, we've added a 5-year ARM. The caveats are a little different. You have to qualify full doc versus where on a Fannie Mae loan, you could provide just W-2s and pay stubs. So no matter what, they want your tax returns. So if there's some K-1 losses in there, that can really blow the deal up. So we have to be cognizant of that and really, really, peel back the layers before we say, hey, this is an option for you. So
I like that. And I like that real estate in a K-1 means depreciation is the loss, so you can count it back in, right?
Yep.
Which is awesome. Okay, 100%. I cut you off. Keep going.
No. I mean, those are the big three, and obviously, we're kind of capped at the 2% concession from a seller, and we've had to work with you guys and coming up with creative ways to incentivize each property and figure out how to keep a loan from pulling the HPML or high price mortgage loan lever, which that credit offsets. And you guys, you've been adding in the prepaid property management or some other ideas to help really drive the rates down in the buy down field on all of those. So it's been good just kind of working in concert with you guys and figuring out good options.
Yeah, I like, that's why I mentioned your creativity, because it's a breath of fresh air over here. Our whole team is like all the love over here. We're like, Brendan's team is the best, and really understanding what we do and understanding how to make it happen. And you're solutions oriented, which is great too, versus saying, oh, we got a problem. It's more of, okay, how are we going to fix this problem, which is awesome. Yeah, we've talked about this before. I don't know if I've talked about it here on the podcast, but we had a lender that we worked with for probably 3 years. He lived in Utah, and he died, and unexpectedly, and it was such a punch to the gut. Not a sucker punch, that's the wrong one. A punch to the gut for us and our team, because we worked so well with him, and we were kind of just having to look for another good solid lender, and we bounced around. For our clients will know that we're moving with different lenders. And when we first chatted, I remember I called Ron and I said, oh my goodness, he's like Chris Palmer. And everybody in our team, if you just say he's like Chris Palmer, like everyone knows what that means, right? And the other day you said, Heather, can you send me like a list of what that means? Because you never met Chris, right? So I thought it was a cool exercise for me to sit and go, man, why was it such a blow for us and our team business wise, let alone personally, because he became a friend over the years. But it was digging into those details is why this list of ideas has come so freely today, because we recently had that interchange. So I think that when you have someone that you work with and lending as a client and as us as a business partner in a lot of ways, that it makes such an impact when you align and work well together. So thank you. A little side note, I guess.
You're very welcome. And it sounded like Chris was a great guy. So
yes,
you guys lost there, but I'm happy to, fill those shoes as well as I can.
Yeah, we appreciate that. So talk to me a little bit about this adjustable rate mortgage as a good option, because before we weren't super excited about the adjustable rate mortgage. I think in a lot of ways it was because the rate wasn't much better, and we weren't in this, upward climb with interest rates as well. And we expect them to go up again. And so if that's going to happen, an adjustable rate mortgage could be really great because we also expect rates to come back down. It's very logical.
For so long, we were so lucky with, I feel like the majority of my career rates have gone down, right? So ARMs were something that, was more geared to folks buying jumbo properties who were putting down a big chunk of money, and they were like, oh, just give me an interest only ARM. I'm not worried about appreciation. I need the write-off, and, I'll move to a different product a few years from now, or I'm not going to be in this property for an extended period of time. So those were those conversations, and everyone else was like, oh, 30-year fixed. I need the security. When in reality, if I went back through my database and tracked everyone I put into a 30-year fixed, I'd say 90% of them didn't stay in that loan for over 4 years anyway, for one reason or another. Right. So just that whole variable nature, I think was taboo for a lot of folks, but, in the environment we're in, I think, it's a good option to look at. It's a 5-year fixed, and then it adjusts every 6 months after that 5-year period. And then year 15, there's a balloon. And I meant to get the caps. So if anybody, is interested, I can get the caps on how much it'll adjust each adjustment and what the max is. Just didn't get that information prior to this call. Sorry about that. But
so you did have homework. No, I'm kidding.
Yeah.
That's okay. That's definitely something we can get later. But I mean, every recession since 1975, interest rates have dropped during the recession, and all signs are pointing to the fact that we are in a recession already. And so I think everyone feels that, right? So if that is the case, then we expect them to drop. When they will, that is the question, right? And so will they drop in the next 5 years though? I mean, I would bank on that.
I would hang my hat on that. I wouldn't hang my hat on some predictions that we had, a few months back, mid fours by, mid 2023. I don't see that happening, but within the next 18 months, I certainly see us in a position where, folks will be able to get out of an ARM and get back into a 30-year fix that makes sense.
Yes, I agree. And now there's such a difference between a 30-year fixed and an adjustable rate as far as your upfront rate. The savings on interest is pretty substantial. I didn't look, I should have pulled the numbers of our last sheet you sent us, but I thought it was over a point.
Yeah, it's really close. And it all really depends too on concessions or how much you want to pay towards the rate. I mean, you can get down there on a 30-year, but it's costly. So making a deal pencil for a lot of folks, the ARM probably makes more sense, especially if there's not, flexibility on the seller side. So you can look at an ARM at, mid sixes at no cost versus to get there on a 30-year fixed right now would be pretty substantial cost wise.
Okay. Yeah, that makes a lot of sense because you do send us a lot of the buy downs. So that's probably explains why I'm like, it's a massive difference.
Right. It is.
So another thing though, too, we've been discussing is what clients say when they hear adjustable rate is number one, like, oh, what if rates are super, super high at that point, right? And you can refinance as well out of them. But what we talked about is that clients also say like, then I have to pay for a refinance. And so we chatted about that a little bit and how to help take away that pain that the perceived pain, I should say, of doing a refinance so soon, especially if they go down next year. Right? Close on a loan and then within like 6 months, it's well, rates dropped, it's time to refinance. So we came up with I'm excited about what your solution you came up with, in that you guys can do a no cost refinance within 2 years of closing an adjustable rate mortgage.
Yeah, we're happy to do that for RP clients and help them, make the transition into something that suits their longer term goals. And it's just kind of a means to an end right now for the affordability issue we're having. I mean, so effectively what we came up with is that refinance, we wouldn't charge any lending fees. So you're effectively saving $14.45 as the cost. So you're just going to be looking at title and escrow fees, which in a lot of the states you guys do business in are relatively cheap. And one other thing that I always tell folks, especially in a refinance market, you do skip a payment. So what I have a lot of my clients do is take that payment and apply it towards those minimal title and escrow fees. So you're not adding any money to the principal balance. Now, if that payment makes sense for you and that money, could be used for something else, so be it. You can roll in those small costs into the loan, but a lot of times, adding those fees and not increasing your principal is the way our clients go.
Yeah, that's super smart. That's a good hack. One thing I've done on a refi too is I reached out to the title company that handled my title work when I bought the property, and they offered a substantial discount because they already held the title insurance and had done the title search in the past. And that was super simple. It was like an email that I sent, and they were like, "Oh, absolutely." I'm like, "Oh,
yeah."
Sweet.
I mean, we could certainly use those teams again to do the refis. I'm sure they'd welcome the business and be willing to work with us.
Yeah, I love that. Again, like just the creativity, you guys, making sure that you're looking for opportunity and problem solving rather than, we talked about this a lot in the masterclass, of just saying, oh, it doesn't work right now, so I'm just going to hang. I'm just going to hang and wait.
Right.
If anything, sitting in the masterclass, even in the presenter seat, I left going, okay, I have reignited the desire to pick up my primary residence because I think there's opportunity right now that nobody is really aggressively moving in the price point I'm buying in. And give it, 6 months, whatever, the rates come down, maybe a year, maybe 2 years. But when the rates come back down, the demand is going to be pent up, and it is going to be a lot of movement. So
if rates get south of 6%, I'm expecting a huge increase in the buyer pool, like massive, tripling.
Yeah.
It'll change because nobody wants to miss out on that window again.
Yes, true. So if you're hanging back and waiting, we have a lot of builders offering concessions that make it well worth jumping in right now and getting moving. So we took a little poll of people who attended the masterclass, and it was almost every single person said, yeah, I'm motivated, I'm excited, I'm confident, like I'm ready to, take action instead of sitting back in fear of what is going to happen. So I think the education in that and stuff I learned too is really powerful. So reminder to listen to those recordings, you guys, because I think you'll really like them.
Even attending or listening to something like that, you're already moving in the right direction, right? Educating yourself and always improve.
That's a good point. That's a good point. And then as far as the ever-changing market right now, another pitfall that we've seen, because I'm seeing it today, is clients who aren't pre-approved and don't have everything into the lender and just think, oh, I'm just going to hang back and wait till the property leaps at me. And then I'm going to be able to get going. Yeah. And I think the logic from that comes from, the market's not crazy right now, so I'll have time. The tricky part is with properties we literally looked at yesterday, and I said, hey, this rate is good for literally like less than 2 or 3 days. We don't know what rates are going to do after that. So these clients that were wanting the properties still today were going, hey, like we gotta get under contract as soon as possible. And they're like, oh, I'm getting everything over to the lender, right? And I'm going, oh, because with rates, we had this happen with another client about 2 weeks ago. That rates went up and dropped his cash flow so significantly that he was down, I think it was well over $100, $150 in cash flow. in between the time that he expressed interest in the property and to when the contract was signed. So paying attention to your pre-approvals, you guys, like it probably sounds like it's no big deal, but if you've got a complicated portfolio, I mean, Brendan, how long does it typically take you guys for someone who's not complicated versus someone who is?
Someone who's not complicated, I mean, I quote 48 hours from once we have their application and the documents we're needing. If it's someone who's a little more complicated, it's all about peeling back the layers, right? Mm-hmm. And then we show them products, and if they want product C, which is probably going to be the ARM, then those layers become even deeper. So having those conversations up front is paramount. I mean, it's we had a client who recently bought a couple properties, and the process was really smooth for them. But unbeknownst to them, those two properties pretty much maxed out their debt to income ratio. So we had to totally change the dynamic of how we approached their situation moving forward, but they weren't really made privy to that by the other lender that they had worked with.
Wow.
And both of those properties, they were turning into short-term rentals, which we can't use rents on. So they're effectively carrying the notes of both of those from buying them this year against their income. So it was a big deal, and they had to pivot and kind of change the approach, but we worked it out. It's just, those are the types of things you want to avoid, right? You don't like those kinds of conversations, especially once you're already in contract.
Exactly. Or even past due diligence, right? Because it took so long for you to get everything in. So it's really, really important to protect your earnest money and to protect what rate you're going to get and the performance of the property. And typically, I would not say typically, but often we're not getting to that conversation until too late when a client's not responsive and sending everything over. Right. So it's it makes it so there's a bit of discouragement on the buyer side of like, man, I really was hoping for this rate. And what you've told me too, Brendan, is you can lock rate with if they're pre-approved, you can lock rate like right then, even before the contract's fully executed, right?
Yeah, I was telling your team this morning, I'm happy to do that in the deals that I can control, which are, the 30-year fix, Fannie Mae stuff. I can lock them internal. We just need the contract within a few days, but obviously that's going to be a file we know is ready to go, not somebody who just is going into contract and we don't have anything from them yet. So it's important just to get in front of it. If you're considering making a move, get with us, let us work through it. We certainly don't, we try and be as gentle as we can, I'll say, when we're asking for documentation, but if we ask for it, there's a reason, right? So everybody doing the best they can to get everything in is always going to work in everyone's favor.
Yeah, for sure. I've done pre-approval with your team, and it was awesome. And I've become a complicated person. I wasn't before.
You and me
but
both.
I've become a complicated person. So it was not a short list of items needed, but having done this long enough, I saw the wisdom in every single one. I'm like, oh yeah, that makes sense that you would need to know that information, right? So, but yeah, it got me motivated and moving on filing my tax returns. So thank you.
You're welcome. Thank
You're
you.
like, if you say you got to file your tax returns, and I'm like, oh man, I really do need to do that. Let's just finish it up. So
it's not very often folks are like, sure, I'll go file my tax returns to do this. So thank you for.
I was really close. I was really close. It's hard to get over the hump after working on it for so many months. I was like, oh man, here we go. And it helped that it was around the deadline, but
right.
I
mean, yeah, so, kind of forced your hand, right?
No matter what, exactly.
This is the best reason to do it.
So I think the takeaways from today would be creative, look at other loan types, and we talked extensively in the masterclass about price reductions versus negotiating concessions and how the concessions are more powerful than a price reduction. I actually, in all cases that I can think of, Yeah. I'm like, I didn't want to make a blanket all statement, but I'm like, yeah, can't think of an example where it doesn't. So, so being cognizant of that. And I even said that on my personal purchases where I know the sellers, I've even said, hey man, would you be willing to charge me a little bit more for the property so I could have some solid concessions?
Yep.
Because it'll help the performance of the property that much. So just math. It's just
Yep.
math. So
Definitely been down that road with several buyers.
yeah. And you're
So a little bit above
helps, yeah.
so we can get more.
Yep. And the only caveat is if it doesn't appraise, right? Then we have to we got to unwind that and, but for the most part, if it's not extensive, it's been just fine. We've rarely had an issue, I should say. So, so we talked a lot about that too, and it was really helpful. So that's another takeaway. And then making sure you're pre-approved. Get your stuff together and you will be glad later. It'll be less headache and you'll know what is happening with your rate when you're interested in a property versus days later. So,
and Heather, you probably remember last time I was on, I talked about a phrase that we work with my team, protect the experience. Well, whenever you get pre-approved ahead of time, your experience is just going to be that much better on the purchase of a property. I mean, that's what it really boils down to. You're going to know what you're getting into. You're going to know where your numbers stand. And it just makes a world of difference rather than scrambling last minute because you really want something. You just don't know if you can get it.
Well, and I would add to that. That's a great point because I think the biggest complaint I hear from clients is when the lender continually asks for new documents
Definitely.
on a tight timeline because you're under contract and you have to close on time. And so when you have delays because of life and your family commitments and work schedule or whatever, it makes the entire experience more frustrating.
Right.
So having that all done up front means that it's you can focus on your due diligence more and other things that are going to be more impactful in a lot of ways than getting in W-2s and K-1s and all that.
And a lot of your guys buyers, I mean, once we start having that initial conversation, they're considering, well, maybe I'll do 2 properties at once, which totally changes the dynamic of the pre-approval. So if that's the case, then we have to be approaching it, even you guys as the buying agents, from a totally different perspective. Maybe we're going to need a property that has rents to help offset on, unit number 2. I mean, there's a lot of moving parts depending on how aggressive folks want to be, in the purchase in that world right now.
Yeah, I love that. Great ideas, great points. I think it's really helpful to be proactive always. So
definitely, I agree with you.
Thanks for joining us today. That was a great update. So
love it.
We love working with you. Thanks to your team as well. So everyone, until next time, get out there and make something happen. And if you're not pre-approved, get it done.
Nice.
Thanks.
I agree. Thank you.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.